What is the capital gains tax on selling land? If you are considering selling land, you might be wondering about the tax responsibilities that come with it. Specifically, what is the capital gains tax on selling land? Let's break it down in simple terms. When you sell land, you may need to pay capital gains tax on the profit you make. Capital gains tax is a tax on the money you earn when you sell an asset for more than what you paid for it. This includes land. The amount you owe depends on how long you have owned the land and your income level. If you sell land that you have owned for less than 1 year, any profit is considered a short-term capital gain. This gain is taxed at your regular income tax rate. If you have owned the land for more than 1 year, the profit is classified as a long-term capital gain, which is taxed at lower rates. For most real estate investors, long-term capital gains are taxed at rates of 0%, 15%, or 20%. The highest federal rate is 20%. Additionally, there may be a 3.8% net investment income tax if your income exceeds certain thresholds. To calculate your taxable gain, start with the sale price of the land. From this amount, subtract your original purchase price, known as your cost basis, along with any costs you incurred to buy, sell, or improve the land. For example, if you bought land for $50,000, spent $5,000 on improvements, and sold it for $80,000, your gain would be $25,000. This amount is what gets taxed. If you are selling your primary residence, there are special rules that may allow you to exclude up to $250,000 of gain from taxes, or $500,000 if you are married and filing jointly. However, these rules typically do not apply to investment properties like land. Real estate investors often look for ways to manage capital gains tax. One common strategy is to hold the land for more than 1 year to qualify for lower long-term capital gains rates. Keeping detailed records of all purchase, improvement, and selling expenses can also help increase your cost basis and reduce your taxable gain. Another option is the 103,100 exchange. This allows you to defer capital gains tax by reinvesting the proceeds from the sale into another investment property. This is a popular strategy for investors looking to grow their portfolios without facing immediate tax consequences. It is also important to remember that some states and localities impose their own capital gains taxes. Rates and rules can vary, so it is wise to check your local laws. Even if you do not owe tax, you generally need to report the sale of land on your tax return. If you experience a loss, you may be able to use that loss to offset other gains. Understanding capital gains tax is essential for anyone involved in real estate investing. By planning ahead and knowing the rules, you can make smarter investment decisions and keep more of your profits.